In the late 1990s, Hewlett-Packard was still widely perceived as a stable institution. Its culture, shaped by decades of internal norms known as the HP way, emphasized engineering discipline, incremental innovation, and consensus-driven management. The company had grown large without ever fully abandoning its identity as a technically grounded organization. Board meetings were orderly. Strategy discussions were conservative. Disagreements, when they occurred, were usually resolved quietly. By 1999, however, the environment around Hewlett-Packard was changing faster than its internal processes. The personal computer market had become commoditized. Margins were narrowing. Asian manufacturers were competing aggressively on price. Enterprise customers were consolidating vendors and demanding scale. Meanwhile, rivals like IBM were repositioning themselves toward services, while Dell was rewriting the economics of PC manufacturing through direct sales and operational efficiency. Inside HP, these changes created tension, even if it was not yet visible publicly. The company remained profitable, but growth was uneven. Its enterprise systems business required scale and capital. Its PC division lacked pricing power. Its printer business continued to generate strong margins, but it could not carry the entire company indefinitely. Strategic coherence was becoming harder to maintain. When Carly Fiorina was appointed CEO in 1999, she inherited this institutional pressure. Her mandate was not framed as a disruption of HP's legacy, but as a modernization of it. The board expected her to restore growth, clarify strategy, and position the company for a technology landscape that increasingly favored size and integration. From the beginning, Fiorina viewed scale as unavoidable. In internal strategy discussions, management teams examined whether HP could remain competitive as a diversified technology provider without significantly expanding its footprint in enterprise computing and PCs. Organic growth appeared insufficient. Acquisitions, once peripheral to HP's identity, became central to strategic planning. Compaq entered these discussions not as a dramatic target, but as a logical counterpart. It was already one of the world's largest PC manufacturers. It had meaningful enterprise server assets inherited from its earlier acquisition of Digital Equipment Corporation. It possessed global distribution, a large customer base, and operational experience in high-volume hardware markets. From a structural perspective, the logic appeared coherent. A combined HP, Compaq entity would have the scale to compete more effectively with IBM and Dell. Cost synergies were projected through overlapping operations, procurement efficiencies, and workforce rationalization. Revenue synergies were anticipated from cross-selling enterprise systems and services to a broader customer base. Internally, early analyses emphasized that the deal was not a bet on growth alone, but on survival within a consolidating industry. Advisors presented valuation models suggesting that, while the merger would be dilutive in the short term, long-term competitive positioning justified the trade-off. The deal structure, an all-stock transaction valued at roughly $25 billion, was framed as a strategic merger rather than a takeover. Within management, support for the deal coalesced relatively quickly. The executive team aligned around the view that scale would determine future relevance. The merger was presented not as a departure from HP's values, but as a necessary adaptation. The board, however, did not align so easily. HP's board at the time reflected the company's history. Several directors had deep ties to the founding families and long-standing cultural norms. Among them was Walter Hewlett, son of HP co-founder William Hewlett. His presence carried symbolic and institutional weight. While he did not represent a majority view on his own, his objections would come to shape the conflict that followed. From the outset, concerns were raised about the merger's underlying assumptions. Some directors questioned whether combining two low-margin PC businesses would create value or simply increase exposure to a structurally unattractive market. Others expressed skepticism about integration risks, particularly given Compaq's own recent experience integrating Digital Equipment Corporation. There were also governance concerns. The scale of the merger would fundamentally reshape HP's balance sheet, operating model, and internal culture. Directors asked whether management had demonstrated sufficient operational discipline to execute an integration of this magnitude. They questioned whether the projected synergies were realistic or aspirational. These disagreements were not initially adversarial. They unfolded through formal board meetings, committee reviews, and advisory presentations. Investment banks and consultants were brought in to validate assumptions. Financial models were refined. Sensitivity analyses were expanded. Management repeatedly emphasized that the risks of inaction were greater than the risks of execution. As deliberations continued, the board split hardened. Supporters of the merger framed the decision as strategic inevitability. In their view, HP faced a narrowing window in which scale could still be achieved through a peer merger rather than a reactive consolidation later. They emphasized that industry structure, not nostalgia, should guide governance decisions. Opponents framed the deal as a deviation from HP's core strengths. They argued that the company's most profitable businesses, printers and enterprise services, did not require PC scale to thrive. They warned that management attention would be diverted toward integration rather than innovation. They also questioned whether the merger would dilute accountability by creating an organization too large and complex to manage effectively. These positions reflected differing interpretations of fiduciary responsibility. Supporters emphasized long-term strategic positioning. Opponents emphasized capital preservation and execution risk. Both sides believed they were acting in the company's best interests. As the board approached a formal vote, tensions increased. The discussions became more procedural and less exploratory. Directors requested additional disclosures. Management circulated revised synergy estimates. Legal counsel clarified disclosure obligations. The tone shifted from deliberation to alignment. When the board ultimately approved the merger by a narrow margin, the decision did not settle the matter. Instead, it relocated the conflict. Because the transaction was structured as a stock-for-stock merger, it required shareholder approval. This requirement transformed an internal governance dispute into a public contest. What had previously been confined to boardrooms and advisory decks became a matter of proxy statements, investor presentations, and regulatory filings. Walter Hewlett emerged as the most visible opponent. Acting through formal channels, he argued that the board had failed to adequately consider alternatives and had underestimated integration risks. He did not frame his opposition as personal, but as fiduciary. His objections were detailed, documented, and procedural. HP's management responded in kind. The company launched a comprehensive proxy campaign to secure shareholder approval. It emphasized strategic rationale, projected synergies, and the risks of remaining subscale. Institutional investors were engaged directly. Analysts were briefed. Media narratives began to form, often simplifying a complex governance dispute into a binary conflict. Throughout this period, the internal experience of the board diverged sharply from the external perception. What appeared publicly as a dramatic power struggle was internally experienced as a prolonged, methodical disagreement over strategy and risk tolerance. Meetings continued. Committees met. Legal reviews were conducted. The machinery of corporate governance remained intact, even as trust between participants eroded. Regulators, for their part, focused primarily on competition concerns. From an antitrust perspective, the merger did not raise insurmountable barriers. The PC market remained fragmented. Enterprise hardware faced multiple global competitors. Regulatory approval, while necessary, was not the central obstacle. The decisive arena became the shareholder vote. In the months leading up to it, both sides intensified their efforts. Management refined its messaging around execution discipline and integration planning. Opponents highlighted margin compression, cultural incompatibility, and dilution of focus. Proxy advisory firms weighed in, adding further complexity to the decision-making environment. When shareholders ultimately approved the merger in March 2002, the margin was narrow. The result reflected not consensus, but a balance of competing assessments under uncertainty. The transaction proceeded not because doubts were resolved, but because enough stakeholders accepted management's strategic framing. Integration began almost immediately. Cost synergies were pursued aggressively. Organizational structures were redesigned. Redundancies were eliminated. Cultural frictions surfaced, as expected. Some anticipated benefits materialized, Others proved more difficult to capture. In the years that followed, evaluations of the Compaq merger varied. Some analysts pointed to improved scale and competitive positioning. Others noted continued margin pressures and organizational complexity. The merger did not provide a definitive answer to the strategic questions that motivated it. What it did reveal was the nature of power within large corporations. The conflict was not driven by incompetence or malice. It emerged from misaligned incentives, differing risk assessments, and contrasting interpretations of fiduciary duty. The board did not fail to function. It functioned as designed, surfacing disagreement rather than suppressing it. The process did not prevent conflict, it structured it. In retrospect, the Compaq merger illustrates how governance mechanisms transform strategic uncertainty into formal decision-making. It shows how mergers are not singular events, but extended processes shaped by valuation models, cultural assumptions, and institutional legacies. It demonstrates that even in organizations known for stability, structural change can expose fault lines that were previously invisible. The decision did not resolve HP's strategic challenges. It reframed them at a larger scale, and the debate surrounding it remains instructive not because of its outcome, but because of how it unfolded, through meetings, votes, disclosures, and the slow accumulation of institutional pressure. By the time the merger closed, the board war had already ended. What remained was the organization that the process produced, and the consequences that followed from choices made under conditions that no participant fully controlled. The record, viewed quietly and without judgment, reflects not a failure of governance, but its limits.